Rwanda's central bank today released the country's monetary policy and financial system stability reports. The two reports took a future-forward look at the state of global and sub-Saharan economies for next year, 2025. Now let's get excerpts from the central bank team led by the governor, John Rangomba.
When we take decisions to lower or increase our policy rate, it's normally based on the trends we see in terms of inflation. The policy rate is one of our main tools we use to deal with inflation. So despite the fact that we see the economy growing this year and we expect to see strong growth even next year, our analysis shows that the growth is not inflation. The drivers of growth we see are not inflationary, so won't add pressure on our inflation. That's why we see projected inflation path of 5% now and next year. And when we normally use our models to show the behavior of inflation, the economy, and what it means in terms of policy decisions. So the decisions we take are really based on analytics done by models, plus of course our judgment as managers of the economy. So we're confident that the growth we see is not inflationary, except as we showed, if there are any unforeseen shocks, especially on agriculture and on the global trade, in general, then that will require us to take other decisions. But for now, if all goes as we see the projections, we don't expect our decision to add to any inflationary pressures because the drivers of the economy are not inflationary.
Since 2022, when Fed started really increasing the interest rates, so it created strong demand for USD assets. Therefore, the value of the US dollar increasing. So that put pressure on developing economies' currencies, local currencies, including our currency, the Rwanda, and it's part of the reason of the high depreciation for last year and part of the year before. But it's not the only reason, as shown in the presentation by the governor. We also have widening trade deficits, therefore a mismatch in the demand and supply of forex, which is also putting pressure on our currency. And we also had increase in international prices, especially in 2022, coming from the war in Ukraine, which made our imports much more expensive. So it's a combination of these factors. But what we can say now is with the interest rates, the US interest rates coming down, then at least this first factor of appreciation of the USD, this first pressure will be lower on our local currency. So we expect to see lower pressures at least coming from the monetary policy in the US.
The good quality of assets, or the fairly good quality of assets, we've seen that at end June, we still had non-performing loan ratio within our own benchmark for banking sector, 5%, and 3.6% for microfinance institutions. And there are three main reasons to that. The first one is that we've seen an enhancement in risk assessment when underwriting loans by all financial institutions. Of course, there's also the regulatory framework that's in place to make sure that credit risk taken by financial institutions is minimized. We also appreciate the recovery efforts on loans or loans that would become non-performing if those recovery efforts were not maintained. However, we've also noticed that in some subsectors, there's an increase in non-performing loans. And that was the case, for instance, on manufacturing. And secondly, when we see these numbers, we don't just sort of take a step back is also to look at other factors or indirect factors that contribute to a low level of non-performing loans.